Hi everyone, this is Alan Rosenfield with Harmony Asset Management. This is our latest edition of Thoughts and Comments. We haven't done a video in a couple of months, and this is because I try and wait until I actually have something worthwhile talking about before we do a video. And there's a lot that's been going on, and so there's a lot to discuss. We're going to break this up into sections. It's a little bit longer. It's about 20 minutes in total. So what we're going to do is first talk a brief review of the markets, the returns year to date. And the reason is this will lead to the discussions we really want to have, which is one, why have the markets been moving like they're moving? What's going on with that? Secondly, active versus passive investing, not from the old point of view of which is better. We can take a very different look at our concerns with active and passive investing. And then finally, we're going to take a look at what we expect going forward and the strategies we're using. Stay tuned. So in this first portion, we're going to look at market returns as the basis for all the rest of our discussion. So take a look at this first chart. This is a year-to-date chart of a couple of different asset classes. We've got gold, treasuries, then we look at two areas of the stock market, the large cap stocks and the small cap stocks, represented by the S&P 500 and by the Russell 2000. And if you take a look at the volatility through all of this, if you bought from day one, what you found is gold way outperformed everything else, up almost 29%. In second place, not too far behind, were treasuries, up 21%. So for those of you that think the treasuries don't move and aren't volatile, this should prove to you otherwise. In distant third place was the S&P 500, up just over 2%. And finally, running up in the rear is the Russell 2000, which was down almost 9%. So not only did we have a lot of volatility, but at the end of the day, stocks have not performed very well. Let's take a look at this second graph, though. This second graph is equally interesting. This compares two indexes against themselves. In the first case, we're looking at the NASDAQ 100, and then the second chart is the NASDAQ 100, but on an equal weighted basis. So rather than market cap weighted, all the components are equally weighted. And then we did the same for the S&P 500. And notice what happened. The NASDAQ 100 on an equal weighted basis was half the return of the standard index. And in the S&P 500 case, it was down 200%. In other words, the S&P was up 2%, equal weighted, it was down 2%. What does this say? This says that the average stock has not participated in the markets this year. They're not up. In fact, as we dig in, we find that a very few number of stocks have made huge moves that are major portions of all these same indexes, and therefore the indexes are up, but it's not showing what's really going on in the stock market. Now, we're going to come back to this when we start talking about passive investing. But first, I want us to talk about what is making these markets move? Why are they moving the way they are? So stay tuned for that in our next segment. So why are the markets moving as much as they have this year? And why are the index up much more than most of the stocks? If you go back and review our Q4 of 2019 thoughts and comments, one of the things we noted was that the markets were all overextended. Debt levels at companies were high, revenues and income were coming down. There was a lot of concern. And we noted that we weren't expecting the markets necessarily to come off much unless there was some black swan event. And I think you can look at COVID and consider that a black swan event. So the combination of the economy, the leverage, and this outside event made it very logical that markets dropped and dropped fast. But why did they recover so quickly? The reason the markets recovered quickly is because both the Fed and the government, Congress with the president, stimulated the economy by throwing money at everything. But we got to look very closely at where they threw this money. The Fed came out and said, we're going to buy everything but stocks. We'll buy ETFs, we'll buy individual bonds, we'll buy corporate bonds, we'll buy municipal bonds, we'll buy everything and anything. We'll lend money, we'll give it away, please take money. And the government did the same thing. They added big benefits to people who were unemployed. They offered loans to people that had small businesses. And they weren't really loans because they said if you do some certain things, we won't even ask for the money back. They bailed out large businesses like the airlines. They've made promises everywhere and anywhere. We went from about $3 trillion in debt to $7 trillion in debt with the new QE. Huge percent of our GDP, and that's a bit of a problem. But all of this stimulus and all of these promises ended up making the markets feel very comfortable that things were going to be protected and they'd be safe, and so they started diving in and buying stocks and bonds again. Now, this in and of itself is a bit of a problem. Investing is taking risk. And people like private equity groups and hedge fund groups that use leverage take a lot of risk. And there is no reason the government should be protecting anybody from risk. When they make mistakes, you should pay the consequences. That's what makes a market work, is that you don't have a guarantee, and so you have to analyze your risks and the potential rewards. The other problem that's happened with the government doing all of this is that they have let companies that should have died stay in business by keeping interest rates artificially low. They have made sure that companies that are barely getting along are able to go borrow money when they shouldn't be. And that's very inefficient. You want capital going to strong companies, not to weak companies. You want to clear out the excess dead weight so that the strong companies can get even stronger. That is the natural way the economy should work. If badly run, poorly managed companies can continue to compete, then they drain from the companies that are doing a good job. And when you let investors be protected, especially when they're really large investors, instead of losing money because that's the risk that they were willing to take, and you get the bad investors out and you let the good investors in, you've done the same thing. You've done nothing but bastardize the stock markets, the bond markets, and the economy. That's why we saw this quick drop and this even quicker rise back up, is because, oh, gee, we don't have to worry about risk. Uncle Sam's going to protect us. But Uncle Sam can't protect us forever, and they aren't protecting everybody equally. Now, let's go to the next topic, which is about the passive versus active investing, because this builds into the same thing. This is not a discussion about which is better. This is looking at what happens when you go to extremes, which is what's happening now. With passive investing, you don't analyze how companies are doing. If they're in the index, they have a weighting in the index. If somebody puts money in, you buy across the index according to the plan. You don't think twice about it. To take money out, you sell it the same way. But what happens when the markets become more of a casino because the government's saying, oh, don't worry, everything's fine, you don't have to worry about risk? Well, you stop thinking about companies as a business that you're investing in, that there's a reason why you own this, and that there's a logic to why you're going to get a return. And it becomes this commodity called a stock. You no longer care what it is you own, you just want it to go up. And if you find a stock that's going up more than others, then you buy that stock because it's going up more than others. Not because it necessarily should, but because it is. That's called momentum investing. So you get momentum investors. Then you get really large funds that come in and speculate, and they know that if they buy certain stocks in large amounts, they have to buy them from somebody. Well, the people they buy them from are other major companies, and those people go, well, but we don't want to risk losing money, so we'll hedge it. So if you buy options on this stock, we sell you the options. But now to cover our protection, or to protect ourselves from the options we sold, we go buy the stock. Well, that pushes the stock up, which means the guy who's buying the options buying more options because it's going up more and he makes more money, and you're selling him those options, so you go buy more stock, so it's becoming a cycle. Okay? Now, tie in the individuals and the pensions and the other people that are buying passive indexes, because look, they're outperforming the active guys. Gee, they must be better. Either that, or maybe the active guys recognize there's a lot of risk, and they recognize that their clients are saying, wait a minute, I don't want to take this much risk. That's what an active manager is supposed to be looking at. So with these passive investors, they've thrown money into the index because the index is going up. And those few stocks in the index that have moved these indexes up so much, so they're much bigger pieces of that index, are pushing it up more. So you put your money in, and most of it goes to those few because there's such a big piece of the index, which shoves the index up more and shoves up those stocks more. And so the momentum guys buy those stocks more, and that means the index go up more, and that means the individuals buying the indexes buy more, and that buys more of that. And they no longer are looking at, is that stock reasonably priced? Is it even close to making any sense? Is it so overpriced that it's absolutely euphoric, makes no sense? Just like in 1999, the last time there was a tech bubble. And everybody said this time's different, except it wasn't. Now they're saying the same thing. It's okay. These are great companies. Tesla had 400 times earnings. None of this makes any sense. Even Goldman Sachs came out recently with a sell on Apple after it split, and ran up after the split because people are buying it because it announced a split, even though that makes no economic difference to them. And Goldman's saying, geez, instead of 120, that could be an $80 stock because they aren't generating enough revenue to justify the prices. Yet the indexes, it's all going straight up. This is the problem with passive indexing in the extreme, is there is no accountability for risk. It's just going up. So when that bubble bursts, for whatever reason, those are all going to come tumbling down. And all these people that said, oh, index works, found it won't work. And guess what? When the markets dropped 35%, it didn't work because there were plenty of investors, many of our own, who were down less than half of that. And that's the advantage of the active versus the passive. So it pays attention to the risk, not just the results. Stay tuned for the next section where we talk about looking forward and what we're anticipating going into the fourth quarter. Welcome back. In this third and final part, we're going to discuss what we're expecting in the fourth quarter. There are a couple of areas that we want to be looking at. The first part is looking at the stock markets. So as we've been saying now, the stock market is, we think, way overpriced by and large, especially when you look at the fact that the indexes are not reflecting the economy. Now, part of the economy is strong. If you are tied to business that helps people work from home, which means technology related, you actually are doing well. But there are plenty of other parts of the industries that are not doing really well. And take anything related to travel. So that's not only the airlines and the hotels, it's the restaurants that are tied to that and the venues that people go. So whether you're a Disneyland or you're a cruise or you could be another country, all of these areas you're seeing weakness because people aren't traveling. And that means all the support services aren't making as much money. So you've got a bifurcated economy, and that's something that we need to recognize and pay attention to. The second part of the markets we want to watch is the fact that interest rates are artificially low. We are seeing a record amount of raises in terms of new debt and new equity for already public companies. But their debt levels were already very high. And my question is, why would you be raising even more money unless you are expanding your business? And most businesses aren't expanding. Some of them are going back to raising dividends. Some of them are announcing share buybacks again. But very few are expanding their capital expense, their CapEx. They aren't building new businesses. They aren't building more plants. Now, some are, but a lot of them are not. So the question is, why? The only reason I can figure is because they're worried about things getting worse and they want to make sure they have enough capital. Once again, something we have to watch. Not guaranteed that it's going to happen, but we have to be watching it. The third area that we want to be looking at is the election. Everybody knows that this is going to be a highly contested election. It's been widely discussed that figuring out who the winner is could take a lot of time, and everybody expects a lot of fights about it. Well, that should make the stock markets rather uncomfortable and more volatile. Typically, the markets don't like uncertainty. So you would think this would be an uncertainty. Now, when you look at option premiums and this kind of thing, Wall Street is betting that the volatility is high in October going into November and then goes down in December. Once again, talking about Wall Street turning into a gambling casino rather than a place where you invest in companies. But they also made this bet back when Trump was elected the first time. They expected the markets to crash. And in fact, the markets went to new highs. So just because Wall Street's betting on it doesn't make it right. So again, I watch this and say, maybe they're right, maybe they're wrong. That is an increased risk. Now is not the time to make a big bet, so I'm watching that. And the last piece is COVID. When we first got COVID, the hope was that the hot weather in the summer would kill it off and it would slow things down, but it didn't. Now you're going back into colder seasons again. On top of which, if you look around the world, Israel has just done a country-wide lockdown again this last week, and you're getting increased reports of COVID in Europe. Here in the States, you've got kids going back to school, and while many were doing it online, they are now talking about bringing kids back into the classrooms. And again, I'm not going to get into a discussion of whether that's good or bad. I'm not an expert. I'm not all-knowing. All I can do is look at it from the economic point of view. I think that the risk that COVID picks up again is high. Now, I don't expect that we'll get another complete close down of the economy, but you will get increased fear. You will get, if you get more sickness, then you will get probably a bit of a slowdown in the economy again. These all lead me to say now is not the time to be making big bets. Now, I'm not talking to the speculators out there, the guys that are looking to hit home runs or grand slams, that are looking to double and triple their money. Yeah, don't listen to me. I'm talking to clients like ours that have taken the risks, they've built their assets, and now they're trying to protect their assets and grow them reasonably with a reasonable amount of risk. Here's our bottom line. Now is not the time to get more aggressive. And we've said this for a while, and we were more aggressive earlier in the year, but now we're going back and we're pulling back again. So one, we're very diversified. We've got stocks, we've got bonds, we've got cash, we've got gold, we've got hedges. On top of which many of our equity strategies, we have now, in the last several weeks, raised cash levels to about a 30% level. So we've locked in some of the profits. We're backing off and keeping cash on the side because I don't want to make big bets into this fourth quarter where we could see a lot of volatility and we don't know what reality is. And again, we're long-term investors. We're looking at 3 to 5 years. 1 quarter out of 5 years is not that big of a deal. But doesn't mean we're sitting on our hands. Out of chaos comes opportunity. I've said this a number of times before. In the last week, the markets have dropped about 10%. Many stocks have dropped even more than that. Well, we've been watching stocks that we want to own because they're in industries that we're very excited about over the next 5 years. They're going to change the way people work, the way industry works. And they've been coming down. And we've started buying them. Now we're only doing little bits. If they come down further, we'll buy more. But we can buy them now at prices that we feel comfortable with. I'll give you 2 examples without the names. One stock was at 228, and we just bought it at 172. It might go lower. If it does, we'll buy more. If it doesn't, we'll continue to buy it as long as it's down here and as we get further economics. Because remember, we've got third quarter earnings coming up just in the next couple of weeks. Second one was at 128 and is now at 106. And again, we'll buy it. We think it's worth 140 in the next 2 years. And so all of a sudden, it's very attractive down here. It wasn't as attractive up at 128. So there are opportunities. We'll take advantage of them. We're not hiding. We're not fearful. We're simply defensive. There's an old adage, he who fights and runs away lives to fight another day. The equivalent in the stock market is he who keeps his capital when things are crazy and risks are high, has it later on to invest and make money. Those who speculate end up losing a lot of it and are busy trying to unbury themselves rather than grow. We're going to be part of the former rather than the latter. Thank you for listening. I hope you found this helpful and thoughtful and it gives you some things to think about yourself. As always, if you have questions, feel free to reach out to us and we'll be glad to answer them. Make sure you click the like button. Make sure you subscribe and you'll hear about our other videos as they come out. And once again, thanks for listening.